A dividend trap is when a company, stock, or ETF offers a very high dividend yield in order to attract investors, but the dividend may not be very sustainable. This is because the company's earnings or cash flow or the ETF cannot support the unusually high dividend. And unfortunately, typically, novice investors are the ones who fall victim to this because they may be tempted to buy into the stock or ETF based solely on the high dividend yield, without actually considering the stock's or ETF's financial health. In this video, we are going to go over why JEPI ETF might seem like a dividend trap, but in my opinion isn't, and why I personally bought over $75,000 worth of the high-yielding ETF. So first, a little bit more about JEPI. JEPI ETF, or JP Morgan's Equity Premium Income ETF, is an exchange-traded fund that seeks to provide income and capital appreciation by investing in a diversified portfolio of equity securities, primarily U.S. large-cap stocks, as well as selling covered call options on those holdings. So in simple terms, the JEPI ETF invests in a basket of stocks that are selected based on certain criteria, such as market capitalization, liquidity, and financial performance. The fund manager then sells call options on a portion of these stocks, which generates quite a lot of income for the fund in the form of premiums paid by the buyers of these options. JP Morgan's JEPI ETF is what we would consider a covered call ETF, and call options are contracts that give a buyer the right but not the obligation to buy the underlying stock at a predetermined price, which is the strike price, on or before a certain date, which is known as the expiration date. When the fund manager sells call options, they receive premiums paid by the buyer of these options, which can help generate additional income for the fund, and which can help pay out more and more dividends to the JEPI investors. So the strategy that the JEPI ETF uses, the covered call strategy, generates a significant portion of income on a monthly basis, which is why JEPI's dividend yield is so high. Let's talk more about JEPI and go over some of the facts and some of the numbers. So JEPI currently is up as of all time around 6.04%, which isn't all that substantial of an overall gain for the ETF price. But you have to remember, for a high-yielding ETF that yields over 10% per year as far as the dividend goes, you normally will see quite a bit of decay in ETFs that pay this high of a dividend. So even though the 6% isn't all that crazy, it still isn't all that horrible considering JEPI's very high dividend yield. JEPI's 52-week range is $49.92 on the low end and $62.60 on the high end. So JEPI as of right now is still trading towards the lower end of the 52-week range. JEPI does have an expense ratio of 0.35% and does pay out dividends every single month. JEPI's trailing 12-month dividend yield is $6.23, which means for every single share that you own of JEPI, you will get paid around $6.23 per year. JEPI's 12th trailing month dividend yield is 11.47%, and assets under management is $23.48 billion, which is quite a large size for a fund like this. Now, JEPI's dividend history is sort of all over the place. There's certain times where JEPI's paid out over 50 cents per share per month, and then there's times where it's paid out around 26 cents per share. But overall, a consistent theme of around 10+% yield per year is what JEPI's given to investors since the inception of the ETF a few years back. Now, JEPI's ETF is not going to pay the same amount every single month because of the way that JEPI works, like we talked about earlier. But if JEPI's dividend history was to stay in line in the future, investors can assume they are going to receive around 40 or 50 cents per share per month on average. With all this being said, let's talk about the elephant in the room. Is the JP Morgan Equity Premium Income ETF a dividend trap? So as we defined earlier, a dividend trap is basically a stock or ETF that gets investors sucked into buying into it just because of the super high dividend. But all along, the investors will be better off investing into something else because the total return is going to decay over time. With the JEPI ETF, I personally do not think that it is technically a dividend trap. Now, right here on the 5-year chart, we have JEPI and S&P 500 on a total return basis for the last 5 years. And one thing to point out real quick, JEPI has not even been around for a full 5 years, so when it comes to this time frame, take it with a grain of salt. But JEPI's returned 40.93% over the last 5 years, which is a lot less of a total return than you normally see with these very high yielding ETFs. Because what happens normally with these very high yielding ETFs is that the dividend returns quite a bit every single year, but the actual share price of the stock or ETF with the most dividend traps decays horribly. Let's use something like Walgreens, for example. And not to pick on Walgreens, but this is a perfect example of a dividend trap. Walgreens does offer a pretty decent dividend yield, somewhere around 4 or 5%, I think. And Walgreens' total return over the last 5 years is minus 31.31%. Keep in mind, this is with dividends included. So those investors around 5 years ago that looked at Walgreens and thought to themselves, well, Walgreens is offering a pretty good dividend, they bought into it, not realizing that Walgreens' share price would continue to tank year after year after year. But when it comes to JEPI on multiple different time frames, it's pretty close to the S&P 500. And again, we don't have all of that much data to go off of because it's a relatively new fund. But if any high-yielding ETF out there can stay sort of in line with the S&P 500 and or even beat it in certain time frames, I would not consider that ETF a dividend trap. Now, of course, like any investment, the JEPI ETF is not going to be suitable for every single investor. The investment vehicle that JEPI provides is for those that want to have income on a consistent monthly basis paid to them, and also those that are willing to maybe take a little bit less long-term growth potential in order to receive income a lot sooner. So for me personally, the reason I bought around $75,000 worth of JEPI over the past few years is because a large portion of my portfolio does have growth aspects to it. What I mean by that is I invest in things that are going to appreciate much more in price in the long term and not pay me as much in the short term. So the fact that JEPI makes up maybe 3 to 10% of my overall portfolio as of right now, I like the consistent income. I like getting paid every single month from the various JEPI shares that I own. I use that income to buy other names like SCHD or other single stocks that I want to hold on to long term. So although the JEPI ETF is by no means the best investment out there in my opinion, I do think that it has a place in many different dividend investors' portfolios. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.